Welcome back to Between Two Fiduciaries. How are you doing today, Jimmy?
I am great, Jeremy. How are you?
Awesome. We're going to dive into dividends this week. All right, this slide is really interesting. This comes from the Capital Group, and they're looking at dividends and how they played out over the last, 80 years.
Yeah.
Okay. And the historic average for return on dividend, 38%. Now, that hasn't been the case in recent years.
Right. So what we're looking at here really is like of the total return, right? There's the price return, the dividend return. The dividend has made up 38% of the total return of the stock market.
Yes, thanks for clarifying
during that time period.
Yep, that's a good point. And you can see in sort of modern day investing since the 2000 mark, it really has been a much smaller number, much smaller total amount that dividends have yielded into that total return.
Right. Yeah. You think about the interest rate environment we've been in has probably been the biggest reason why the dividends have been such a low contributor to the total return, because as interest rates have been so low, it's forced the stock prices up much more than the dividends been able to keep pace with the price appreciation.
But if you go back in time, in the high inflationary times of the 70s, they played a big role there. And it's the reason why some of the portfolio managers out there feel like we might be in a shifting landscape, that the dividends could play yet a bigger portion of the total return going forward than they have in the last 10, 20 years.
Absolutely. I mean, if you believe in reversion to the mean, it's a powerful story.
Well, that's that. So let's take a look at what else is going on here. So let's dive into the S&P 500. And of course, there's a lot going on here. What we want to bring your attention to is the yellow framed box at the bottom shows the dividend yield that each of these sectors within the S&P 500 is producing, and then the 20-year average. So you can see there's quite a bit of variation there. On the low end, you have tech. Tech is known to be a growth-oriented type of environment. They do not typically produce a lot of dividends.
Right. These are companies that are taking their profits or whatever profits they may have, and they're reinvesting back into research and development. They're possibly looking to acquire competitors in the space. They're not returning a lot of the cash back to their shareholders. They're hoping to grow the overall value of the business more than they're returning income. But the other ones that you've got highlighted box in the green, the energy sector, the real estate and utilities, these sectors are a much different story.
They are, and their goal is to return some of that cash to the shareholders, and they've consistently done that. Energy, 3.3%. The 20-year average a little bit lighter than that. Real estate, not surprisingly, one of the leaders here at 3.8. It's actually a little bit shy of its 20-year average at 3.9. And then utilities have traditionally been this space that you go to for dividends, and they're at 3.3. Again, a little bit below their 20-year average. So look, their dividends are alive and well. They are part of the mix. It's just a question of what sector is really playing into this, and it tends to be more the value-oriented stocks, right?
Yep, absolutely.
All right, talk to me a little bit about dividends and taxes. Let's take a look at the left side of this diagram first.
So I think that if I could say it in the most simple way possible, it would be that the taxes on your dividends will never be taxed at a higher rate than the taxes on your ordinary income or wages from an employer.
Okay.
As simple as that. Taxes on the qualified stock dividends will never be taxed at a higher rate than your ordinary income.
Okay. And
so the fact that we are lower is a better thing.
Always. So let's use an example, right? If I've got the ability to get a 3% dividend yield out of a stock, and I know these are comparing apples to oranges, so don't get me wrong, but that 3% yield off of a dividend stock versus 3% interest from a bond, from a tax perspective, what am I better off with?
Yeah, so that's a great question, and the answer is the stock. Again, to your point is apples and oranges. There's a lot more price fluctuation typically inherent with the stock. But if we're just comparing the 3% dividend yield to a 3% interest rate, the interest income is going to be taxed as though it were your wage income, ordinary income. Whereas the tax on the stock dividend, it's potentially tax free, depending on what tax bracket you're in. It has the potential to be tax free. But again, at a minimum, it will be taxed at a lower rate than what your ordinary income rate is.
And we'll get into that tax-free portion in a moment with the next slide. The question that I want to ask is, so if you have a qualified dividend, does it matter whether you reinvest it or take it as cash?
From a tax perspective, it doesn't matter. You're paying tax on regardless whether you reinvest it or you take it as cash. I would say most of our long-term investors would reinvest the cash from the dividend. That typically provides a better total return in the long run. But for those that are retirees that might be living off more of the portfolio, having that income stream from the dividends can be a nice boost for or support from the income stream, and maybe a little bit less reliance on the total price appreciation of their portfolio.
Makes sense. All right, here's what the IRS says, right? So you were alluding to this earlier. Let's focus in. Of course, there's different, taxpayer types. There's single taxpayers, married couple filing jointly, and head of household. Let's look at the married filing jointly for a moment here. So what are you seeing here? The 0% that you alluded to this earlier.
Right. So if we start on the far left column there, we see the qualified dividend tax rate, 0%. And if we jump over to the third column for the married couple, what we're saying here is if your total taxable income, so that is all of your gross income minus deductions, whether that's a standard deduction or itemized deductions, if your total income is less than $89,250 of taxable income, then all of the dividend income that you have that could be making up that $89,250 of income is taxed at 0%.
Got it. So to your point about retirees, a lot of folks are in that camp,
right?
And they're able to glean those dividends at a tax-free rate.
Right. It's again, this is like one of the more complex tax planning theories that we discuss with our clients, but there's some real value to be had here if you understand this and invest accordingly.
And again, to your point earlier as well, the vast majority of people who are workers would fall into the camp of this 15% tax rate, where as a married couple filing jointly, you're between $89,000 and $553,000. Boom, that's 15%. Again, that's less than most people are paying on their ordinary income tax.
Right, that's exactly right. So
it tops out at 20%, right? So for the highest earners, those above $553,000 a year, 20%.
Right, and for some perspective, the top tax bracket right now is 37%. So you got 37 versus 20, right? Again, there's always nuance to taxes, but I think this chart tells a lot that there's enough to be gleaned from this, which is it's important to understand this and the integration of how this plays out with your investment portfolio.
All right, the key takeaways here. So dividends are getting a facelift, or maybe that's one of the theories out there. They could see a greater importance in your portfolio. We want to make sure that this is placed in context of what a good asset allocation would be. We are not recommending to people that you go all in on nothing but dividend stocks.
It's an important data point, right? There's no question. It garners a lot of attention, especially given the high percentages we saw in that first chart of how much dividends played a role in the total return over the past few decades. But it's one data point. It's not the only data point that should be relied upon when making an investment decision.
And then the tax location and tax planning will produce alpha. So the alpha is the outside score, outside return that you're going to get when you factor in taxes.
Again, we talk about this a lot. We know how important this is. I think it's something that is underappreciated, broadly speaking, but we know how important this is and how much value can be added to the portfolio from an alpha perspective by doing this properly.
And using that example that we had earlier, if you have a bond that's producing interest,
right,
put that, if you can, in a qualified account that's tax sheltered.
Right.
Right. If you the dividends, sure, they can go in there too, and they're going to be 0%. But again, remember where you shape up on the IRS's table.
That's right.
And then lastly, selecting the right dividend producing stocks is critical. So there's just some different sectors that play out, and some different areas that maybe are a little bit better than others.
Right.
One of the ones that the Capital Group has been talking about lately is pharmaceuticals.
Yep.
They see that as an area where you can get a nice dividend yield, but your stock is also appreciating as well. So it's just one of those things that seems to be a hot topic right now. I thought we'd bring that up.
I think it's a great topic.
Thanks, everybody. That'll do it for this week.